coming into the day, I have a clear short bias. I always find my bias on the daily time frame. Um, when you have your bias, that doesn't mean that you have to take that particular trade. Like, I'm short for the day, it doesn't mean that I have to take a short. It just means ideally, if I want to catch the biggest and most high probability moves, I will be taking a short for the day. If I take a long, it will be less size and less duration of a trade. But after I determine my bias on the daily time frame, I go straight into the 15 minute. Oops. Um, Easily. And we see here my main point on this expansion leg down, which happens right after London session. I'm looking at these fair value gaps for us to retrace into to create the move down. First, I look at this one and this one. These two fair value gaps are where I'm expecting price to draw to. That never happens, but at market open or right before market open, we have an SMT at these highs and we sweep out this liquidity. Now, once we get the change in the state of delivery after sweeping out the highs, that's enough for me. I have confirmation that market is going to move lower. So I can go straight to the 1 minute and look for an entry. That's all you need to do. Once you have confirmation on the high time frame that market is going to move lower, go down to your smaller time frames, whether that's the 1 minute, 5 minute, 30, 15 second, wherever you like to trade. As soon as you know that market is going lower, just go straight to that smaller time frame and get on side with the move. Now, there's no entry here. Ideally, we would have had our entry up here, but this is before market open. We're not even looking here. So market does open. We have this expansion leg down. There's nothing. Once we get this retracement up, now I am really looking for an entry. This is where I'm sitting here and I'm paying attention, looking for fair value gaps, order blocks, breaker blocks, anything that I could get into the trade. What happens? We get the push up, we get a change in the state of delivery, and we push right back up into a fair value gap. That's all you need. As soon as I see that, I'm entering this trade. So I place my limit order right on the bottom of this fair value gap. Gets tapped in here at 10:02. I place my stop right above this high just to cover some risk, because we tapped into this fair value gap perfectly and pushed lower, but we could come all the way up to here. There's no saying that the market will reverse here. So we cover our loss for this, or we cover our risk. Get tapped in, no drawdown. What is this, like 3 points of drawdown? Straight to take profit. Well, not straight to take profit, straight to my first take profit, which was a 2-to-1 risk to reward. Then my second take profit, all the way down here, it gets hit. Long time later. During this time, I just leave. I do whatever. Now, why was this my take profit? I can back up to the hourly time frame. Liquidity. Liquidity down here. I place my take profit here. And this is a beautiful trade. Yeah, it was a lot longer lasting than I would have liked it to be. But literally after I move my stop loss to break even, I just walk away. And I wait. Come back an hour later and take profits hit. It's really not that hard once you determine where liquidity is. If you know where liquidity is, you know where the market wants to draw to, you can trade at any time of the day, any duration of time. You could have trades that last a minute, trades that last an hour. Once you determine where the market wants to go, you can trade. And that's really all this is. Now, I saw a lot of people on TikTok taking inverse fair value gap entries instead, which those are great entries. It's just not my model. People ask, why do I take the fair value gap when I could have gotten a better entry off the inverse fair value gap? I trade my model, and that's it. If I see something that might present me a better risk to reward, I don't need to take it, because that's not the way that I trade.